Good evening. It's Doc Severson with a TheoNight report for Tuesday, February 20th. Starting off tonight's report on the S&P 500, just to remind you all the way along here, I kept mentioning that we were in quiet and trending market character, and I said that what we'll see next is the market start to expand the size of the range. Now, we didn't anticipate necessarily that we're going to see this monster moonshot to the upside, but what we're seeing actually now perfectly plays along with what we're expecting, which is a transition into sideways and volatile market character. So sideways and volatile is what we're expecting to be in for perhaps the next few months. Now, what does that entail? Which way is it going to go from here? And what's the next trading setup? So to answer those questions, I need to build some framework because honestly, I don't know what's going to happen tomorrow or the day after that or the day after that. I have no view into the future that's going to tell me which way to trade and what strategy to use. So what I need to do is to build some framework in order to make some decisions going forward. So as you'll see, there's three different possibilities that I'm going to talk about in terms of what could happen perhaps in the next 30 days, whether the market goes up, whether it goes sideways and then goes up, or whether it goes down to retest the lows. Let's look at all three of those scenarios and the framework that I would have to employ in order to determine whether it's going to fit into one of those three scenarios. Now, I should say before I get into this, for this framework to work, you have to pretty much set aside your own personal beliefs and your biases and anything that you think is due to the market. So if you're of the camp that says, well, the market has been misbehaving for the last couple of years and I believe that it has to go all the way back down to 1800, then this type of framework is not going to work for you because you will be unable to see what's actually happening. So you have to kind of set aside all of your biases, set aside what you think should happen to the market, and simply set up the framework to let you understand what is actually happening at the current time in order to make these decisions. So scenario number one is the V-bottom. And the V-bottom occurs when we go from normally quiet conditions and all of a sudden things start to spiral out of control. The ATR increases and all of a sudden this selling increases the further this goes down. So just like every other move to the downside, the selling is the strongest at the very bottom as people wash out of their positions. And then what happens is certainty comes back into the market in a V-bottom. Certainty comes back in and all of a sudden people expect the bounce, but they don't expect it to go any further. This is where disbelief comes into play. And all of a sudden, next thing you know, everybody's back on their heels, chasing after this market, having missed the move off of the bottom. So what causes these V-bottoms? Why are they different? And how can we determine whether or not we're in a V-bottom right now in the S&P? Well, this V-bottom by itself, you may recognize from 2014. It was in the October timeframe of 2014. And normally the V-bottoms like this are caused by one singular catalyst, one single event that kind of kicks things off. And then as certainty comes back into the market, this is where all of the late shorts are just scrambling to get out continually. So this is where people go way too short, way too late in the pattern. And then this fuels a massive short covering rally as certainty comes back in. So all the fears that generated this move to the downside are completely reversed as people say, oh, well, that's really no big deal. Why did we make such a big deal out of this? And if you do recognize this one, this was the whole Ebola crisis that we had back in October of 2014. So you don't hear too much about it today. And what happened is the market had completely discounted this fear by the latter part of October and caused the V-bottom to occur. Now, the problem with spotting the V-bottom is it's not that easy because there's very little structure to go on. So in other words, there's really no wave structure other than the fact that we went from range contraction, kind of a bear flag, that released to the downside, and there was no structure. In other words, there was no higher low, higher high, higher low, higher high. This was just a complete and total mass murder of the shorts on the way back up. Complete covering rally. So what we have to do here is a relatively simple trick with technical analysis. Using fib retracements. So regardless of what you think about fib retracements, here's where they can provide some value. I don't think of them as being predictive, but they do set up a nice framework. So basically the issue here is that of a sell-off here, if the price is able to reclaim on a closing basis at least 61.8% of that move, then the odds have definitely gone in your favor. The probabilities are much, much higher now of completing the entire triangle, filling in that entire triangle. And this is kind of where you are. Now, you may be saying, hey, well, what about all of this move down here? Well, it's very, very difficult to catch a falling knife. These moves are so rapid, they come so violently, that all you're after is really just the meat of the move. Being able to catch at least a chunk of it is really what we're after on any of these swings. So to determine whether or not we're actually in a scenario one with a V-bottom in today's market, I would put a 61.8% fib on the S&P. And if we did get a closing value above that, which we did not on Friday, we got slightly above it, but we did not close above it on Friday, then more likely we are going into scenario number one with a V-bottom. So the way to trade these is what I love to do. I love to sell into spiky bottoms like this. I love to get that implied volatility sky high and then sell put credit spreads way out of the money. There is no replacement for displacement. And then what happens is when we finally do get the relief rally, then what happens is all that implied volatility comes flooding out. We have a long delta position. We have a short vega position. Both of those are accelerating the gains in our favor. So we're able to get normally a very quick profit on this trade. And the entry point is not that critical. As long as we're selling into a good spike that allows us to sell positions that are below what we consider to be support, it's an excellent trade. And then what we can do is go long above this 61.8% retracement with debit call spreads. So we flip around and play long call spreads. And the reason why we play these as in-out spreads is because we're still going to have a fair amount of volatility crush on the way up here. So we have to do these at the money so that they're neutral with respects to the Greeks, which are helping our put spreads, but will work against us if we don't play these in the correct manner. All right, scenario number two is, as you can see, this is a bottom retest. So we thrust down initially and we bounce up kind of weakly. Normally, this is very much of a grinding move, as you can see, and then eventually it, with the help of this kind of topping candle here, a shooting star, rolls over and retests the bottom again. And then it's free to do what it wants to do. Normally, it will bounce from here. Okay, so how do we identify something like this? Well, we can use the same tools as before. We can use that fib retracement up there. And as long as the price stays below that 61.8% fib, chances have increased that it may, in fact, retest the bottom. Now, we'll see a third scenario in just a minute here, which is kind of a hybrid of these two. Okay, but we'll also notice that we do have a defined chart pattern here, which in this case is a bear flag, an extended bear flag that sets up usually with declining volume and eventually will break to the downside on increasing volume and retest that bottom. So how do we play something like this? Well, again, I love selling into that initial spike with put spreads. These are short put spreads, or you can even sell puts if you wanted to. Okay. I will try to sell call spreads above the recent highs if possible. So I'll look for the first available bounce back up before the volatility bleeds off too quickly. And I will try to sell credit call spreads, bear call spreads, whatever you want to call them, above the recent highs if I can. Sometimes you can, sometimes you can't. Usually by the time it's bounced up and ground higher like this, all the implied volatility has come out of the move. So you're not really able to benefit from that too late in the move. So you got to get that first bounce back up again to be able to get those call spreads above the money if you can. All right, so that's the second thing to do. Third thing to do is to sell second spike to the downside with short put spreads. So I keep hammering as often as we get these moves where we get a nice implied volatility spike into there. I want to sell those put spreads and use this type of volatility to sell premium when possible. And then, of course, we can take long debit call spreads on the bounce. After we bounce from here and start to show motion to the upside again, we can go back in with in-out call spreads and get the long. And that brings up scenario number 3. This is kind of a hybrid between the two previous ones. What we will see, and this one goes back a few years actually, goes back about 11 years, is that we'll see some type of initial thrust down and then a bounce back up. And notice this one goes above the 61.8, but instead of just V-bottoming straight up, this has already exhausted itself. And so what it needs to do is it needs to fall into a range until it builds up enough energy, and then it will break out normally in the same direction as what it came from. So normally it will break out to the upside, although I have seen them break down to the downside. So we want to stay agnostic here. We want to stay neutral, look for the break, and just take that break in that direction. Although this one gave you a nice hint with a higher low setting up nicely. So higher high, higher low, break above there, in you go. So let's see how to play this one. Again, we want to watch out for that 61.8% fib of the first move down. And after that was broken on a closing basis, then there is a much higher probability that the entire triangle will get filled in again, especially if this came from a bull market. Okay, so the second thing that we'll notice is the range. So we don't get the initial move on there. So perhaps you played this as a V-bottom trade, being that you got the close above here, but this is not going to necessarily work against you all that bad unless you have a very short-term duration trade in play. Okay, so the range comes next. So how do we play this? Love to sell into the initial spike. That's no surprise. Long debit call spreads on the bounce. So we could play on the bounce as the retest of the lows to get the initial part of that move. Or we can also play them on the breakout from the consolidation. So I will say that if this had broken down, this is where we could have entered long put spreads from here, looking for that lower high and then a retest of the bottom. But it would be really rare to see a retest of the bottom so soon after this one already did so. Now, I know that probably some of you are thinking, well, what about scenario 4? What about maybe the price just keeps on going down and keeps on going down and maybe even bounces back up and then keeps heading down? Normally, it just doesn't happen like that. We have not seen any good examples of that. So barring any exogenous events that come into the market, some disaster, which I don't even want to talk about, then this is unlikely to happen. We will see one of the 3 types of character that we just talked about. So that was 1987. Even this one did show a bottom retest and then a constructive rally from that point, even though it did take years to reclaim the highs. Even the 1929 crash obeyed the same type of structure, right? So from here, lower high, initial swing down, okay? And then it started to build constructive structure, okay? Eventually it did turn over, but this is a classic example of quiet and trending moving into sideways and volatile structure. And that was that way for quite some time, several months before it did finally start to trend down into a 4th type of character, which is also known as a bear market, which is volatile and trending. So we've not seen volatile and trending market behavior since the spring of 2008, when we printed a massive lower high and things started to come apart at the seams. Okay, folks, I hope that helps. That is how you can identify how to set up framework to look for opportunities with what should be a nice volatile market here for the next several months. And let's not worry too much about what it turns into after that. Let's focus more on what we can make with this opportunity right here, right now in the next 30 days. Thanks for listening, folks. We'll see you tomorrow.